What's good with y'all, man? Today, I'm giving y'all a strategy video. Now, this really should be, if y'all are familiar with ICT concepts, y'all already know what my strategy is. Now, honestly, my strategy is very deep. I don't know. Y'all gonna have to look at ICT's concepts, bro. Because I'm about to explain a lot of shit, and it's probably gonna lead to more questions than answers. But it is what it is. I'm gonna do my best. I'm not a professional at this shit yet, none of that. So, first things first, I need y'all to understand that everything that I'm about to explain in this video, it's all just theories. It's all just theories, bro. Is there an algorithm that controls price like ICT says? I don't fucking know. I don't know, to be honest. Is it just support and resistance? I don't know. I don't know what the fuck it is. My personal belief is that every single strategy can work for you if you learn it for long enough, if it makes sense with your brain and your way of thinking, and if you study price action for long enough. At the end of the day, it's about the market experience you gain with a certain strategy, right? So that's all I can say. But every strategy is really just theoretical. There's no way to prove most of this shit. Now, there's probably some people out there that know exactly how the market moves and they can prove it. I'm not one of those people, bro. I don't know if it's an algorithm or not. All you can do is take the concepts that people are giving you, whether that's support and resistance, whether that's goddamn indicators, whether that's ICT, SMC shit. All you can do is take what they're giving you and go and apply it in the market and see if it makes sense to you. See if you can see the things happening that they're explaining and stick with that strategy. There is no secret strategy. I personally think ICT is the best for me. Objectively, is he the best? No, I can't say that. I don't know who the fuck is the best. Everybody is different. Trading is very subjective. For me, the reason why I like ICT's concept so well is because there's a story behind price action. Everything makes sense, even though it's very intricate and it is somewhat complicated, especially as a beginner. It all makes sense in my brain. There's a story, and my brain likes complex things. Let me just put it, step one. What's the first thing we're looking for? Step one, find the DOL. What is the DOL? The drawn liquidity. Okay, so we're trying to figure out, based on previous price action, where this price wants to go next. We're trying our best to figure out where this price wants to go next. That's what the drawn liquidity is. Now we got to get into what is liquidity. See, it gets very complicated. You got to get real deep. Liquidity it's money. Essentially, it's money. So let's just, I'm gonna just use an example real quick. Like, let's say we get into a trade right here. Let's say we're using support and resistance. And we get into a trade right here. We see that we broke through right here with this big candle. We bounced and we came up, and then we came back down again and we bounced. So I get in right here as we start to come up because I see this rejection. I put my stop below this low right here. Right? Boom. So now my stop loss is down here. Well, guess what? When you get stopped out, your position goes into the markets. It floods the market. So let's say I had a big ass position right here. I'm risking $100,000. All right, boom. We just going through. Boom, I get stopped out, right? This right here would cause my 100,000 that I was risking to leave my account and go into the market. Really, it's going into another person's account, but I no longer have that 100,000. Is now the market's money. With that money, we can use it to then move the market the opposite direction. We can use the money that I just lost to push the market. Alright, I'm gonna make this quick, so I'm editing this video, right? This is my strategy video, my day trading strategy, blah, blah, blah. So in this part of the video, I was talking about liquidity, right? And I was saying if I got in long right here and I got stopped out, my 100,000 would go into the market. What I didn't mention is this buy order right here would turn into a sell order. Okay, so I'm buying with $100 risk. I mean $100,000 of risk, right? When I get stopped out, I have to sell. That's why you're losing 100,000. I have to sell with a $100,000 loss. So now a sell order worth 100,000 is coming into the market. The reason why this is liquidity is the way that orders get filled, right? So each price, so right here in the corner, you can't really see it. Let me zoom in. Right there it says 18,065.25. So that's one price in my example that I'm about to explain. Each price level has a certain amount of orders that are there, which is ask and buy, right? I don't know the specifics about the ask and buy, but just understand there's ask and there's a buy. Essentially, my $100,000 order would get stopped out right here, and at this price level, which is 18,065.25, there would be $100,000 worth at that price level. So that means however many contracts is worth $100,000, that's how many would get filled at that price in order to move it to the next price. Understand? So you have to fill all the orders at one price in order for price on the chart to move up more. So what smart money does, right? This is ICT concepts. Again, it's all theories. I don't know what's real or not. I don't know if it's fucking true. I just know it works for me. With smart money concepts, what smart money does, which is the big players, the institutions, the banks, they want to fill as many orders as they can at lower prices. If they're buying, they want to buy at the lowest prices possible. So what they will do is they will stop out traders to generate liquidity. So let's say they want to go long right here. They will push the market down into their stop losses to create a huge pool of liquidity with a bunch of people with sell orders, because they just stopped out people who were long. A bunch of people with sell orders at this specific price right here, 18,065.25. So now they can fill hella orders at 18,065.25 before it goes to 18,065.50, because that's the next tick up. So now instead of, let's say before they stop this big player out, the one in my example, the $100,000 player, before they stop him out, there's only $1 worth at here. That means if they bought $1 at this price, it will go up to the next price. So now they're buying at a higher price. So they will stop you out. And then they have to fill so many more orders. Or they can fill so many more orders at the same price. So essentially they're buying at a lower price. That's what liquidity is. I did not go deep enough into this at all. That was a very bad explanation. So I had to redo it real quick. I hope that makes sense. Anyways, back to the motherfucking video. That's essentially what liquidity is, and I hope that makes sense. If not, I'll have to really do a whole deep dive into it. Alright, so that's step one, is find the draw on liquidity. So how do we do that? Well, we look for liquidity sweeps. That's like the biggest thing, a liquidity sweep. So right here, boom, we can see that we came up, we took out these highs, which, as I just showed y'all, stopped some people out. Once we sweep that high, we go to a lower time frame and we see how we reacted. Right here you can see we pushed down and we broke structure on the 4 hour. We created this fair value gap right here. We came up and we respected it. So now what are we? We're bearish. This leads me to believe we're going to be bearish, right? Okay, so where do I think the market is going to go? Down. So I think the draw on liquidity is lower. I don't know exactly where yet, but I think it's lower, right? I need more information though, so I'm going to scale down to the 1 hour. Now we have even more information to go off of. And when you're scaling through the time frames, you're seeing more and more information, more data. And when you combine that with the higher time frames, you can come up with a story of what price wants to do. So again, we had swept this area up here. then we broke structure to the downside, and then we started to retrace. Now another tool I like to use is equilibrium. So you take the Fibonacci tool. Let's just go to the settings real quick. You take the Fibonacci tool. You don't need these green areas at all, so you could take all this off. But the equilibrium is a 50%. So make sure one of these boxes is checked off and it has a 50% mark, and make sure there's a 1 and a 0 so you know the top and the bottom, right? So boom, we take the Fibonacci, and since we're bearish, we're using the equilibrium point for the retracement. So if we're bearish, we're trying to see how high will this leg up go before we start to go down, right? Let me explain that one more time, okay? Again, our drawn liquidity is lower because we swept these highs and we broke structure on the 4 hour and the 1 hour, right? But as you can see, even though our drawn liquidity is lower, we're starting to come back up. Well, how far can we anticipate that we're going to come back up? To wherever equilibrium is. And usually this 0.62 level is very, very significant as well. It's called OTE, which means optimal trade entry. That's a 0.62 level. I personally don't use it too much except for as confluence, but the 50% level is really what I use the most, which is equilibrium. So you can see we came up into equilibrium, we tapped the 62% level, and then we started to drop. So that's a very good area to look at when you're looking for retracements. Now, the reason why I know this is just a retracement is because I believe we're going way lower than this. Why do I think that? Well, we're going to use equilibrium again. We're taking this low right here to this high. Why this low? Because this is really the start before the leg up. You could say this is the start before the leg up, but we had a big push right here, and then this came down and didn't take out this low. So this is really the lowest low in this leg, right? So we take this to the high. And the reason why we're going to this high is because this is the high that swept this liquidity that made us have this bearish sentiment in the first place that led to this move down. This is going to sound very complicated, but I'm trying my best, bro. I'm sorry. I'm trying my best. Alright? So we take equilibrium from this low to this high, and we can see that this is the equilibrium mark. And this also lines up with these highs right here. And this is also known as a breaker. So this is a 1 hour breaker block. We also have this 1 hour fair value gap. 1 hour bullish imbalance. So this is really where I expect us to go lower to, somewhere in this area. This is my drawn liquidity. Now I don't know when we're going to get there. I don't know if it's going to be this week or if we're going to continue to consolidate. But I do believe we're going to end up in this area soon. Right? Now, I'm obviously, if I was going into a day, like if today was Monday morning and I saw this action, I'm probably not going to look at this and be like, okay, we should target this low. Because we're on the 1 hour time frame. I trade off the 1 minute and the 5 minute. Right? So we have to scale lower. Now, before we scale lower, I do want to show y'all that we came up into this order block, fair value gap, and order block right here, and we tapped it. If y'all don't know what order block and fair value gap is, I'll have to make a whole nother video on this, and I probably should have did that before I made this strategy video, so I might have to remake this shit later in time. But let me know if y'all understand this. So we came back up into this fair value gap, and we swept this high right here, right? So inducing more liquidity by stopping out whoever was short right here and had their stops right there, allowing us to move the market lower. And again, we're at equilibrium of this range, which is usually where we're going to retrace to. And we tapped into this fair value gap. And the fair value gap is a liquidity void. So once we come up in here, it's easy to go the other way. That probably didn't even make sense. I'm sure that didn't make sense. But essentially a gap. We're gonna have to go over that in another video, bro. Cause I feel like I'm getting all over the place right now. But I'll make another video on all these little concepts if y'all need to. Liquidity sweeps, fair value gaps, order blocks, all that shit. Right. Anyways, we sweep liquidity right here. We tap into this fair value gap and we start to sell off. Now this price action right here is not the best because it's really from the end of Friday and the start of today. But based on this, I can anticipate that we're probably going to sell off soon. We might have another sweep up, but let's go back a little bit so I can really show y'all. Because from this point on, like once I go into the 15 minute and I see that we tapped into this and we swept this right here. Oh, this is later in the day too though. That's not the best. But it's okay, I'll show y'all. Right here, I'll be anticipating a reversal. So I'm gonna scale down into the 5 minute and the 1 minute, etc. and see what are we doing. I need to see exactly how price is starting to react on these lower time frames because I anticipate a rejection. But if I were to stay on the 15 minute, it would be too late. I would see the rejection and there would have already been a setup on the lower time frames. Right? So I go to the lower time frames to anticipate what price is going to do based on what I'm seeing. So usually if we're in an area like this, I like to see a 5 minute market structure shift as confirmation. Or some type of big push down like this. And we can see we kind of want to go to the downside. I was scaling to the 1 minute. And I'll look for a setup in that as well. So we had a buy side sweep right here. And then we had an internal sweep. Which is also a form of manipulation, right? And now y'all gonna be like, what the fuck is manipulation? Manipulation is essentially a move that makes people think that it's going one way and then we end up going another way. So it usually happens after a major buy side level gets swept. So this buy side level gets swept. We create these highs. We start to chop a little bit and then we push up. So it looks like we're breaking out of this consolidation and we're going to go towards the upside. But if you are aware of the fair value gap that's up here, you'll recognize that this is manipulation. We're taking out this high, we push up into the fair value gap, and then we start to sell off. Now right here is where I'll be looking to take an entry, somewhere in this area. And there's obviously no entry here. It's late into the day, it's around 2 p.m. You're not going to get any entries in this area. But essentially that's my strategy. Now, I don't even know if that made too much sense. I'm going to keep it very simple with y'all, alright? So, I'm going to go back to this box and I'm going to write down the steps again. Well, I haven't wrote them down yet at all. But I'm going to write down the steps, then y'all rewatch the video and hopefully it makes sense. If not, I will make a video explaining liquidity sweeps, fair value gaps, order blocks, all that shit, equilibrium. That's going to take me a while, but I'll make a video for each one of those things. And then I'll remake a strategy video. Alright, so number 1, find the draw on liquidity. Number 2, we'll start on the higher time frames. Analyze higher time frames. We'll look for liquidity sweeps and new structure to find potential draw on liquidity. Scale to lower time frames. Look for break of structures and see what PD arrays are respected. Okay, what is a PD array? PD array stands for premium discount array. So a premium array would be a high. I don't know if a high is actually an array, but essentially fair value gaps, order blocks, breaker blocks, all that shit. Those are arrays. A premium array is something that's in premium of a range, which is above that 50% mark that I showed y'all. that would be above this red line. That's a premium array. And that's usually something that we expect price to bounce off of and go lower because we're in premium. A discount array is something that's below this red line that we expect price to bounce off of and go higher. Okay? And those are usually fair value gaps, breaker blocks, and order blocks. Now we want to see what gets respected. So in this case, we go down to the 1 hour. It's pretty clear because there's a lot more candles to go off of. You can see. Am I still on replay? You can see. I'll get rid of this. Right here. This is a premium array. It's a 1 hour bearish fair value gap. We came up and we bounced off of it and started to push lower. That means we respected it. If we respect a premium array or a bearish anything, if we respect a bearish fair value gap or order block like this and we start to reject it and push down, we can expect that we will continue down to whatever low there is, whatever fair value gap, things of that nature. And the biggest thing with these is you want to align it with other things, right? So we got this fair value gap right here, but if we scale down, you can see right along this fair value gap, there's some lows on the 5 minute, which means liquidity is resting in here, right? So now we can anticipate that if we come down here, we might bounce, or we might not bounce at all, but we can anticipate that price will come to this area, right? Just off of that shit. And we actually did come into this area and fill this fair value gap and then bounce up. But again, we're still not in discount of the overall range. We also swept all-time highs, which is a big thing. Now with all-time highs, you never know if we're going to keep going up or what. That's why you have to go down to the lower time frames as well to see what have we been doing. Anyways, let's go back to here. So scale the lower time frames, look for break obstructions and see what PD arrays are respected. Continue lower on the time frames and try and find a precise area or precise level. So the key level. And try to find a key level that price is likely to draw to. So essentially what you do on the higher time frames is what you do on the lower time frames too. But you're just trying to build a story. That's why you start with the higher time frames. So on the daily we have this sweep. Then on the 4 hour we had a break of structure. On the 1 hour we had fair value gaps that were getting respected and a push down. You're doing that all throughout the time frames. 15 minute, 5 minute, 1 minute. And all you're doing once you get down to the 5 minute and the 1 minute, you have the 4 hour, the 1 hour, the 15 minute, and the 5 minute. All that you looked at to build a whole story, so you're very confident in where price is going to go. It's going to be a lot easier to see, okay, price is probably going to go lower. And you have all of these time frames to build a story off of. So you're really trying to scale down not as low as you possibly can, because sometimes you get too deep into it and it just starts getting confusing. Like when I first started, I couldn't trade on the 1 minute because it was too much noise. Now it's pretty simple for me. It takes practice. But you're trying to build a story. That's why you start with the higher time frames and you scale down, because you're building confluence and probabilities. So yeah, once you get to the 1 minute, you're basically entering based off of a model. So the model that I use is usually some type of buy side sweep. Make this black, make this one. The model that I use is usually some type of buy side sweep. And this is in a bearish market. So this is when I already see the daily, the 4 hour, the 1 hour, the 15 minutes all aligning to be bearish. Right, so on the 1 minute, I'll look for a buy side sweep. And if it taps into a higher time frame fair value gap or some shit that makes it even more higher confluence, but I don't always need that. Alright, then after the buy side sweep, if we get an immediate break of structure and a fair value gap in here, I'll take that. But what I usually like to see is another push up to take out those highs right here, and then a push down through the low to shift market structure. Now this is kind of ugly, but you'll be alright. You get it. So we sweep buy side right here. Boom. We sweep buy side. We come down, then we push up, and we sweep the internal highs. And if we're trading NQ and ES, it would be perfect if NQ came up and took out this high and ES didn't, to create an SMT, right? So an SMT is just a smart money technique, smart money tool, or whatever the fuck it's called, but it's an SMT divergence. So if we see that one pair came up and took out this high but the other one didn't, and showing weakness between the pairs, and since they're correlated, it's likely that we'll get a push down. But that also has to be in alignment with higher time frame structure. You can't just see a SMT and short immediately. Not every SMT is going to work. It's all about confluence. It's all about bringing together everything to make the strongest story, right? So boom, we get an internal sweep, we push down, and then we shift the market structure right here, and then I wait for a pullback into a fair value gap, which is usually my favorite. Sometimes I'll take an order block as well, or a breaker block, but I like fair value gaps. And then I just take it to whatever the draw on liquidity is. Now you have higher time frame draws on liquidity or lower time frame draws on liquidity. You're using the higher time frame draw and you're trying to align it with the lower time frame draw. Right, so right here on the 1 hour, my higher time frame draws is 1 hour fair value gap down here. But if I scale into the 1 minute, I want something that's going to align with that draw on liquidity, meaning something that's lower in price. Again, it's literally just adding up all the time frames and shit and figuring out the best possible, the most probable fucking thing that's gonna happen. Now I usually like to target equal lows and shit like that, but again, my targets are mostly gonna be based on equilibrium. If y'all listen to this video and watch my old videos or my live trading videos, when I'm analyzing the markets and then when I take a trade, you're gonna see this shit. But let's say I'm taking a long right here. Actually, because I think we already hit equilibrium. Yeah, let's say I'm taking a long right here. Right, we don't have any equal lows, but you see equilibrium's right here. We're probably going to reach equilibrium, and then we're going to take whatever high there is within that, whatever buy side level, or we're going to tap into a fair value gap within that level, right? So essentially, at minimum, we can expect that we're going to go to this 50% mark. And even on top of that, our draw is always going to be a fair value gap, a high, or breaker block, or something like that. So we can target the first fair value gap, high, breaker block, order block within the 50%, which would be right here. So you could target this level right here. Or you could target these highs. If these were equal highs, it would be much better. And I usually like to target highs and lows. I don't really like to target fair value gaps. Right? So yeah, that's usually what I do, man. Find equilibrium. Everything that you do on the higher time frames, you're gonna scale down and do on the lower time frames. It's all fractal. So however you analyze the higher time frames, you're gonna do that with the next one down and the next one down and the next one down. That's why you're scaling. You're looking for PD arrays that are respected. You're looking for equal highs and lows. You're looking for shit that gets disrespected. If you see a fair value gap get ran through, like if we got a like this bearish fair value gap right here. If we see price come up like this and just continue through it as if it doesn't exist, we're probably not gonna go lower. Shit like that. You're just looking for clues in price. So you try to find key levels that price is likely to draw to. And then you look for a model like I just showed you. For me, it's a buy side sweep, usually an SMT, a market structure shift to the downside, and a fair value gap entry. And then I put my stop above the high of the fair value gap. That's usually how I enter. So that's really my strategy. If that didn't make sense, I'll try to make another video sometime. Who knows when. And I'll also explain fair value gaps and liquidity sweeps and order blocks if y'all want me to at some point. So that's all I got for y'all. I hope y'all enjoyed that. Again, if this is very confusing, just let me know. I'll make another video sometime. I hope that should help. Yeah, that's my strategy, man. Y'all be safe.